Good morning, and welcome all to our sixth webinar as part of the In the Room series. Thank you for joining us, and we are always aware and of your precious time, and we really appreciate it. So thanks to the audience for joining us. My name is Steve Backhouse, and today I'm chatting to Victoria Reuvers and Debra Slabber from Morningstar Investment Management. Welcome, Debra and Vicky.
Thanks, Steve.
Good morning, Steve.
Before we kick off, just a couple of normal house rules, as always. So just for the audience, we very much try and make these sessions as interactive as possible. So please post questions in the Q&A tab. I think, as you know, we disable the chat tab, but the Q&A tab, and then we'll monitor those and ask the relevant questions. We'll try and get to as many as we can, but often they're far too many for us to actually answer them all, but we do try our best. Based on the format for the webinar is I'll chat to Vicky and Debra for 20-25 minutes or so. Then we'll hopefully have a pause, have a look at the questions, and run through the questions kind of where we need to, and then I'll probably get back in the conversation with Debra and Vicky, and then we aim to end at 10:30. So what we do is the webinar is for an hour, and we make sure we don't go over that hour. Lastly, then is the CPD points process. And that's very important for all. So if you attend the majority of the webinar, I think it's between 90-95% of it, then you'll receive your CPD point certificate via email tomorrow. If you do have to drop off for whatever reason, then what we would do is we send you a recording of the webinar which you can watch, and then unfortunately there's a short assessment which you need to complete to receive your CPD certificate. Cool. Otherwise, I think that's it on the house rules. So to kick off, first of all, I think, Vicky, maybe it's a good idea if you can give a short introduction about who Morningstar are, and what you guys do for the people who don't know you.
Sure. So good morning to everybody on the call, and thank you, Steve. It's great to be here with you. Morningstar is a NASDAQ-listed company, and it turns 36 years this year. Our head office is in Chicago, but we have offices in 27 countries around the world. Morningstar does many things, and one of which is actually the recent acquisition of Sustainalytics, which I hope you will get to touch on later. But we're a leading data provider. We have fantastic technology and tools. We do independent manager research, so providing fund reports on different managers in a forward-looking basis. And then we have the investment management business, which in South Africa is often referred to as a DFM business. Globally, Morningstar has been doing this for, as I say, almost 36 years, and we manage about $220 billion globally in investment management / DFM assets. So from a South African perspective, Morningstar came to South Africa 11 years ago with the acquisition of S&P Fund Services. Many people on the call might recall the Micropal report. I actually sometimes still get asked for the Micropal report. That is what we acquired, which is now the new Morningstar report, which gets published monthly. The investment management business, which Debra and I represent today, which is the DFM business, we're going into our 6th year. And really what's great about what we do is we get to leverage our global capability and bring it to South African advisors. So we have experts in the field in SA, but we leverage off one global framework which has been tried and tested through 35, 36 years of business, and we get to bring that to our advisors. So it is tricky working as part of a global team in such a unified format, because it means we have calls and meetings at all times of the day, because we're trying to juggle between Australia and the US and the UK, but it does make for interesting work. So I guess, Steve, from a Morningstar perspective, what sets us apart in SA is that we're truly independent in the research we provide, in the data we provide, and in the portfolios that we build for advisors.
Yeah, but I mean, I definitely want to chat a bit later about the sustainability what's it, acquisition, especially on the ESG side of things. Because again, I think as you and I were chatting the other day, it's definitely something that's big globally, but again, it's not as big in the SA market, but it's probably coming. But that's for maybe later on the webinar. Right now, I mean the topic for the webinars on the invite was very much about global investing and the trends that have kind of taken place for SA investors over a period of time. So Vicky, as you say, you've been in the industry for quite a while. I mean, can you take us back to kind of your thoughts on the start of global investing for SA investors?
Yeah, thanks, Steve. I have been in the industry for over 2 decades, so it does make me feel a little bit old. But I started my career in 2001, and it was a very interesting time to start because if we recall, 2001 was a time where the rand was very weak, the US was all the craze, everyone was taking their money offshore, and then we actually saw this kind of decade of strong SA growth, rand strength, and the last decade for US equities. But if we cast our mind back to 01, there was only about 56 billion rand invested in global funds. And what we found was many of the managers that came to South Africa to sell global product sort of arrived, they had a foreign accent, they sold a fund. And if we look at and the assets in global funds now, which is well in excess of 500 billion, a lot of those managers are not the managers managing money. And the reason for it is what happened is, if I just rewind the clocks of the global financial crisis, if I mention the word Glanmore or absolute return fund, a lot of advisors were sold funds or products by global managers who, when times got tough, those managers didn't come back to support those advisors. And they were really left in the lurch. And for many investors who still hold the Glanmore property fund, as the example, they're still being charged fees, they can't get their money out, and it's 12 years later. So there's an inherent skepticism that came with foreign managers coming to South Africa to sell product. But then we look at the decade of sort of 01 to 2010. So that was the last decade for US equities, rand strength. Anybody had taken their money offshore in 2001 lost a lot of money, just even on a dollar basis. And we saw good economic growth in SA. But it also coincided at a time where South African balanced funds became hugely popular. They gathered an enormous amount of assets and market share. And the reason that I mention this is that for a lot of the largest South African managers, they used this time to build and enhance their in-house global capabilities. So Reg 28 it gave you an allowance initially of 15%. We know that that's grown to now 30%. But over that time, these South African managers really built a good global capability. In the years post 09, and from the global financial crisis, we know that that's the last decade for South African investors, and we know that US equities and global has been an incredibly good place to be. But what a lot of South African managers did is they also replicated a well-known local range in a global range. So if I can think of in the balanced fund space, you've got low, medium, and high equity funds, and they created global solutions that replicated those. Interestingly, global balanced funds are very popular in South Africa, but it's a bit of a South Africa phenomenon. They're not hugely popular globally. Globally, portfolios are built at a more of a granular level. But what this has meant is that South African investors have gravitated towards local managers, global funds, and they've actually been served very well. Performance has been great. And I think it's also just that knowing who to speak to when times go tough and that managers will be there. The one thing I would say is they're quite expensive, Steve, not just by South African standards, and global standards. But now, over the last few years, what you've started to see is a lot of foreign managers actually re-enter the South African market. So it's kind of a bit of a full circle we're seeing, but they're coming in either, they've learned their lessons by building distribution in South Africa. Take the likes of Schroeder's, who've done a very good job of that, Saracen, or via sub-advised accounts through Ned Group, who've brought us the likes of the Veritas, FPA, BlackRock, Dodge and Cox, who've come into the country. So a bit of a full circle, but I think the landscape has changed and the access to global managers is definitely much better now for South African investors than what it was 20 years ago.
I mean, quite a solid strategy by the asset managers. If you think about it, build the capability, that performs well, you replicate it. And actually, when our our last decade is actually then a lot of assets start going offshore, where you actually the capability is built, it's got a track record, and then you capture that end of the market. But as you say, things are starting to change. I mean, Debra, to bring you in now, what do you think the biggest changes over the years were for investors?
Steve, I think actually a lot has changed, and I mean that in actually a good way. And I think, first of all, when you think about an individual's offshore allowance, that's changed dramatically. You can basically today invest a huge amount of money if you have a tax clearance certificate from SARS, and up to R1 million with no prior approval. So a big positive change for investors. And then, of course, I think the amount of investment vehicles in South Africa have increased substantially. And platforms are largely to thank for that. I think back in the day, it was just used to get your money out with any product. Now there's a much bigger investments. The amount of platforms obviously also increased. And I don't know if you can remember, but Steve, back in the day, it was really just Old Mutual International. And today we've got a lot of players, and including yourself, the rise of DFMs. So that has also changed. And DFMs really in the South African landscape, they are bringing true global solutions to local advisors, which is fantastic. And then, of course, there's also these select managers who have bought the distribution rights for some quality solutions. So I'm thinking about the likes of a Net Group or a Veritas. So yeah, good positive changes.
So this obviously, I mean, it also then brings so it does bring some more choice, which brings more complexity. I mean, that's something you have to be aware of. I mean, that's hopefully a role that you guys play in the DFM space, is actually you try and kind of reduce the complexity into a solution that the advisor and the client can understand. I mean, what other benefits are there for the advisors now going to see their client with this complexity?
Loads of benefits, actually. So the first thing is definitely reduced fees. So Vicky has mentioned that fees have reduced dramatically over the past couple of years. South Africa's not there yet, but we're getting there. Better platform functionality. I think platforms have really pulled their weight in this instance. And then, of course, access to this phenomenal global managers that we really spoiled for choice. So I think there was this big mind shift where global investing used to be scary. It used to be quite intimidating for local investors, and that's definitely not the case anymore. And if I think about offshore investing, a few years ago, it used to be just this plan B for advisors. And today it actually forms part of the financial plan right from the start. And you see a lot more transparency today. You really spoiled for choice when it comes to providers. And as I've mentioned before, when you think about these providers, they've become a lot more investment focused, which is a good thing. It's not just product focused. So there are great benefits for investors locally. So I think we're on a good path.
Yeah. So again, back to you, Vicky. I mean, so obviously, as you mentioned, you're part of Morningstar. Morningstar has been around for 36 years or so. Now, from a South African perspective and your team's perspective, how do you go about then building solutions for advisors and obviously for the end client at the end of the day?
Well, firstly, Steve, we're fortunate to have the likes of innate platforms that do give us the ability and the functionality to build great portfolios and to access good managers. So thank you from our behalf, because otherwise we would not be able to bring our global capability to SA. What we have is a team that provides very strong, first and foremost, what you need is a good investment focus. The concept of DFM in terms of blending balance funds is not a value add in terms of investment capability. What we do is we start with our capital markets work, and our capital markets work is bottom up. We have analysis on every single share in the world, which is rolled up, and until we can actually find areas where we are seeing the best opportunity. We then express that at a granular level through funds where we've done independent fund research to invest in areas where we see the biggest reward for risk for investors. So we can build portfolios at a granular level and to express our highest conviction asset allocations, leveraging off our global framework. So to give you an idea of what that means for advisors is, if in the models that we run, they're expressed through model portfolios, so they may see a number of underlying holdings. But, and I don't want to talk too much about product here, but just to put it into perspective, we can build our portfolios, our low, medium, and high, and equity portfolio, including our fee and VAT. The TIC ranges between 72 to 88 basis points, which is very, very, very cheap. If you think of an average balanced fund in South Africa, an average global balanced fund, the TIC is about 188, and they're some well in excess of 2 or 3%. So if ours are coming in about 78 basis points, the reason we can do that is because if you think of a balanced fund that has, let's call it 40 to 50% in fixed income, if you're paying 188 for fixed income assets, we can say we actually want to buy US treasuries, and we can access that for 8 basis points or 10 basis points. So we can buy individual asset classes at a lot cheaper prices, which means that you're paying the fees for the assets that you want to get, which means the total cost is much lower to investments. So by leveraging off the capital markets work that's done by the global team, we can express this through our global managers. And this is in no way a dig at South African managers. It just means that there's a huge cost to running businesses, and globally the scale means that you can access much better fees and reduced costs.
I mean, so I do want to actually touch on some of the fee stuff, but I think we'll do it just now. But first, because talking about the model portfolios, I mean, they're often seen as complex. So Debra, I'm going to bring you in now. I mean, are model portfolios complex, or do you think they actually make life simpler for advisors and clients?
Steve, the honest answer, I think it actually simplifies life a lot. Some of the benefits of global investing I've mentioned earlier, but some of the benefits of model portfolios, there's a huge amount of benefits. And I think it's about the way that you position it with your clients from the start. So very often what scares people is a couple of strange names on their underlying statement that they've never heard of before. They've never seen these guys. They've never attended a presentation or a webinar of these managers. And it's quite scary. But I think as an advisor, that's an incredibly important role that you play to position the model portfolio correctly. And I think a good start is to position the firm that's managing the model portfolio instead of promoting the underlying funds. So that's a good start. To be frank, the underlying funds are going to change in any way. Things that you can mention to clients when partnering with Morningstar is things like, Vicky mentioned that we've been around for 36 years. We've got representation in 27 countries. We manage well over $200 billion globally. There's a huge investment focus, so investors can really rest assured that their money is looked after. And we've got loads of material that we always share with advisors to position Morningstar better with their clients. And secondly, if you think about this, the model portfolio specifically, lower fees, it's great diversification. You've got access to great global managers. They are handpicked, they're monitored, they're researched by a team of dedicated and experienced investment professionals. So yeah, I think model portfolios is actually fantastic. Of course, transparency for Morningstar is incredibly important. So transparency when it comes to the underlying investments, transparency when it comes to the fees. So if an end investor is curious as to why we're including a certain fund manager or a certain fund, we're more than happy to share any of that research with them. So we'll never invest in something that we can't explain. So model portfolios is really just bringing all the Morningstar capability, when the investment firm's capability, into one cost-effective solution. So getting back to your question, I think there are lots of ways that you can position model portfolios in a good way to end investors. I don't think that 15 underlying funds that you'll see on your statement, that's not a reason not to invest in a model portfolio.
And Steve, if I may just add one additional benefit for advisors on models is that when the change is made, all of their clients will be treated exactly the same at the same time. So that reduction administrative burden that requires actually switching every single investor. So you can get one motivation around an investment philosophy and all clients are treated identically. So in terms of from a compliance perspective, it actually adds a huge, takes a huge weight off your shoulders as well.
Very good point. Yeah, exactly.
I think, and I'm not just saying this because I'm talking to the likes of you. I'm big fans of DFMs and what you do, because I honestly do believe that you take a very complex global world out there, and you simplify it for your advisors and clients, and then on top of that, actually, you're often able to reduce the costs, which is often a surprise to many advisors. So yes, you obviously charge a fee for your services, but your underlying portfolios you get a lot cheaper than what a kind of your everyday advisor in the street can get. So before we move on, I just wanted to just remind everyone, please send through questions if you've got. Don't hold back. As I say, we want to make this as interactive as possible. So any questions on what Morningstar do, or specifically on global investment and global investing themes and those types of things, please shout. So we've spoken about. So one thing I want to just get to quickly, and I'm probably jumping around a little bit here, is we spoke earlier about Sustainalytics. So, and I know I got my tongue tied a little bit, but you mentioned you purchased, Morningstar purchased Sustainalytics a little while ago, quite recently. Can you give us a sense exactly what they do? And I'd love to get into this conversation of ESG investing.
Steve, I'll take that.
Yeah.
Sustainalytics. So it's great news for the Morningstar family. We're very passionate about ESG, so the environmental, social, and governance part of investing. And yeah, as Vicky said, Sustainalytics is actually a very recent addition to the Morningstar family, and they're just strengthening what we already do. At the heart of Morningstar's lies our research, and Sustainalytics. If you think about what they do, they're a globally recognized leader in environmental, social, and governance research. And Morningstar is a leading independent investment researcher. So it comes together, and it's a big focus on empowering investor success. So to give you an idea on Sustainalytics specifically, so the data that they have is on over 40,000 companies globally. They've got Sustainalytics or ESG rating on 20,000 companies. They cover about 172 different countries. They've been around for about 25 years, and there was about 650 people in that team that came across to the Morningstar family. So it really creates scale for us to influence capital across the investment spectrum, and to make ESG going forward part of every investment consideration. So yeah, it's quite exciting. It's exciting times for us and for our investors.
So question on that from our side is it, so they specifically look at companies. Now, how does that then translate into when you guys are putting your portfolios together? You buy portfolios. So then do you kind of overlay the company ratings underlay it into the portfolios to have a look at it like that?
So Steve, it's ESG is an interesting one because there's no one way to look at ESG. And I'm going to answer your question in two parts. The first is to say that what Sustainalytics provide is bottom-up data at a company level. So you can get your carbon footprint, look at the proxy voting, you can come up with a rating. But what we found is that most South African investors actually don't know really where to start when it comes to ESG ratings. And so what we find is there are three typical avenues. The one is exclusionary. So people will say to us, I don't want to own a company that's, does animal testing or, tobacco, gaming. And so that's one way. So you invest by exclusion. The second way that a lot of people look at investing is in terms of impact investing. They say, I want to invest in companies that are creating a more, investing in green technology or investing in solar. And then the third way is, which is more relevant to South African investors, not in the global investing universe, but in the South African market, is to say, hey, our market is made up of mining, tobacco, oil, and banks. We're not exactly an ESG positive country in terms of at an index level, But if I'm going to own a mining company, what is that mining company doing in terms of trying to reduce its carbon footprint, like within the mining industry? What are they doing from an environmental impact perspective? So within that environment, you can have good mining companies and you can have bad mining companies. So that's all at a bottom-up level. But that again doesn't answer your question of what do investors do who are buying unit trusts. And so from a Morningstar perspective, when we do research, we spend a lot of time analyzing the parent, and we want to understand at a parent level, are you a good steward of capital? And what's very interesting in South Africa, particularly with the state capture, with Steinhoff, with EOH, with Old Mutual, the list goes on, we are saying to the asset managers, as stewards of capital, what are you doing to look after shareholders? What are you doing with your proxy votes? What are you doing to ensure that there's good diversity, that there's cultural inclusion? What are you doing on behalf of the investors? And so this is a question that we raise with managers. So from a South African perspective, if you're looking at South African portfolios, you want to be asking your managers those same questions, because ultimately our universe of what we can buy is not very green, if I can call it that. From a global perspective, there are many, Morningstar's got many ESG indices. We've got global ESG portfolios that you can buy. But the reality is ESG is massive globally. You cannot go to a manager meeting or build a portfolio or have a client meeting without ESG consideration being brought up and without it being looked at. In South Africa, it is not a question that comes up too much, but it should be a question. And to me, the days of thinking that it's something that I shouldn't worry about are gone, because a good investment is a sustainable one. It means a company's got to have good governance and good awareness for their social and environmental impact. So I think it's here to stay, and I hope investors ask more questions.
Yeah. So a good also another example be, and the Alan Gray were in the press not so recently, but they were questioning the Naspers kind of REM structures. Now that's a good example. That's example for you, is that they're really they're not just sitting there taking the share price growth, but actually interrogating how the company's been run from a sustainability point of view.
Absolutely. Alan Gray are actually very, very good in terms of being very active with their proxy voting. So for a lot of advisors on the call, that all the assets that the managers manage on our behalf, they get to vote on our behalf on any company decision that comes through. And traditionally, proxy voting has just been a bit of a tick box exercise. And those days are really gone, because activist shareholders, the likes of Alan Gray, are saying, 91's another one who's also been very good, are saying, well, actually, no. So we're not going to pass that through. Sasol is a good example where both Alan Gray and 91, I know, really questioned directors' remuneration, a whole bunch of, and which resulted in change. So you're seeing this more and more, which is what you want to see. It's what you expect of your asset manager, because you can only generate long-term good returns if you have a sustainable business, and a sustainable business needs to have good governance, and these are the questions that need to be asked.
Yeah, and also, I suppose, I know also that a lot of the mining companies, another example is that a lot of the mining companies, they were doing a lot of tick the box environmental impacting or social and actually it wasn't actually necessarily, it was more just ticking a box and not actually for the better of the community, etc. And a lot of that has just changed because of the pressure of the shareholders are putting them under. So we've got some nice questions coming through, which I would like to get to. So thanks all for sending them through. So first one is for you, Vicky. It's quite a specific one. Do you have a China and India focused option available? Not a general shotgun emerging market fund that includes these two.
No, we don't have a specific portfolio that targets that, unfortunately.
No. Okay, cool. Now another one. Okay, so again, also, so for Debra, so again, maybe Vicky's just answered, but again, I think I'm going to hand it over to you. Is why do you think ESG matters for South Africans?
Well, I think, Steve, it's South Africa. We're always known for following what the developed world does. So the US and other developed markets, they're quite far ahead. Like Vicky actually already answered this question. They're quite far ahead when it comes to that. But I think eventually it filters down to emerging markets and ourselves. And more on the ground, when we talk to advisors and to end clients, more and more people care about this. And I think and as you say, so we can't ignore this anymore. So it's surfacing a lot in conversations. So yeah, I think that's here.
And I suppose also you say, yeah, go for it, Vicky.
Sorry, can I add a comment on that? Which is that, state capture and all of the corporate corruption that we've seen, I think really has brought to the forefront the fact that as investors, we have to be able to hold institutions accountable. And the people who are going to hold them accountable are the managers who actually vote on our behalf. But we cannot grow this country if we allow a culture of corruption. Everybody hates state capture, but there were corporates that enabled all of that to happen. So it is hugely important. If there was ever a time for us as investors to have a very, very strong view, because the ESG, the governance side of it is hugely prevalent in SA. And that's where I feel that a lot of the focus should be.
Is there also, again, and I completely agree with you, but also in this day and age, you can't hide. So, the age of Twitter and social networking and all those and movements, and how quickly they actually get kind of people in action behind them, is you also can't hide. So if you're going to do something a little dodgy, and the kind of everyone gets behind, people find it out and then get behind it, the news spreads very quickly. So it's also just from a social perspective, is actually you do need to kind of do things the right way.
But Steve, people can't hide, but there's been very little repercussions. There's been very little consequence for the actions, which is what needs to happen. And that happens at an investor level. Because as soon as those funds dry up, if managers don't invest in corporates until change happens, change will happen quite quickly.
Yeah, no, it's absolutely good point. Cool. Okay, another question. They're coming thick and fast now, which is what we like. Debra, underlying managers in your DFM service, do you invest in third-party funds, or do you have segregated mandates with managers?
Sorry, Steve, I couldn't hear you quite
well. I can take that question if need be.
So it's simple. Do you hold portfolios, or do you hold portfolios and a combination of segregated mandates? Vicky, if you want, or Debra, can you answer it? Yeah.
Yeah. So we invest in. We do research on fund managers, and then we go. So we've got an asset allocation view, and then we go and find actual funds that express those asset allocation views. So very, very simple.
We do hold seg mandates for certain South African funds where we can't access asset class to through unit trusts.
Okay, cool. Cool. Okay, so then I think just getting back to some of the stuff that we've been talking about, and we actually spoke also about the role tech plays. So tech is becoming a lot more important in the kind of the investment world. How does tech support Morningstar's business, Debra?
Steve, I think tech is incredibly important, but maybe I should answer that question and just take a step back and just explain where we fit into the bigger Morningstar group. So Vicky at the start did mention how we fit into the business, but I'm just going to reiterate that. So Morningstar Inc., so that's the NASDAQ listed company in the US. So that's the data and the tech side of the business. So interesting, they were actually nominated as the second most disruptive tech business in the world. Can you believe it? Most competitors, most asset managers actually use our flagship system called Morningstar Direct. So Morningstar Investment Management, so that's a wholly owned subsidiary of Morningstar Inc. And in the South African business, so we known as the DFM, forms part of that investment management business. So tech, huge influence on our lives on a daily basis, and it's really an enabler of the company. So I want to actually give listeners just an idea of the magnitude and the size of this. So if you think about the investment database that we operate, it's one of the largest globally. So there's well over 1 million securities. If you think about the amount of data that's stored, it's over 4 petabytes.
Hang on a sec here. Can you explain what a petabyte is? Please.
I actually can, and not because I knew it, because I actually had to go and look this up when I started at Morningstar. A petabyte is actually 1,000,000 gigabytes or 1,000,000,000 megabytes. So if you think about the pictures and the movies and the series that you download and store, 4 petabytes it's a lot of data. And that's not where it ends. If you think about the real-time data that we get on a daily basis, so real-time data means that every time a security price updates or a trade goes through or anything like that, there's about 1,000,000 messages every second of every day that's coming through. So think about that, 1,000,000 messages every single second of the day. There's about 12 million people across the globe that uses our website. There's about 1,500 employees that just works on the infrastructure and engineering of this machine. If you think about the amount of data centers, because if something falls over, there's going to be chaos. So there's 8 data centers across the globe for backup. So it's incredibly powerful and it's massive. So, and if you bring that back to South Africa, so I mentioned the DFM business that forms part of Morningstar Investment Management, we also have a huge amount of complexity that we deal with on a daily basis. To give you an idea, there's about 10,000 individual investor accounts that we check every single month. Do they comply with their mandate? Are they in line with what they need to be invested in? Is there any drift? So yeah, so tech, incredibly important. It complements the business to a great degree. But I think maybe, Steve, it's important to highlight, we don't rely on tech to make the investment decision. So we're still an active manager. We follow a valuation-driven approach. We build portfolios from the bottom up. Tech just enables us to access the research and the data better. We don't rely on tech to make the investment decisions.
So it's interesting. We actually had Tom Walker from Schroders on the webinar 2 months ago, and one of his comments is that data centers are the new beachfront property. So basically what I mean is, and again, actually the conversation was actually about how COVID's going to have a negative impact on property. And his view is yes, but if you own the right properties, there's an opportunity. And the data centers, for example, was one of those examples. How they are growing, and actually also that you want them in kind of key positions, etc. So, and those are the things that keep us going today. Now the days we are working on Zoom and web and the like. So another questions come through for Vicky, and another section something we spoke about is the global trend for DFMs moving more to a building block approach or multi-asset funds? Now, I'm not sure if the question's asking is, are the guys creating funds for advisors, or is it actually kind of building block versus balanced funds in a model portfolio?
Steve, one of the things about DFM in South Africa is the original birth of DFM centered around functionality at a platform level, and to remove complexity and allow advisors to bulk switch and have a concise investment view. From a global perspective, as I mentioned, the concept of balanced funds it's not very popular at all, and we would argue there's not particularly a large amount of investment science in terms of blending balanced funds, other than perhaps diversifying across managers, but it doesn't give you a portfolio of conviction, and it is a little bit, it's more expensive. So Morningstar's view is that at the heart and center of a DFM business, you need a very strong investment capability, because ultimately, who is our competitor? When we build a portfolio, we call it Morningstar Balanced Portfolio, our competitor is a global balanced fund, because we are building a target risk portfolio that is trying to provide a solution for an advisor. It can be used, I guess, in conjunction with other portfolios, but we would say that yes. So to answer the question, globally, DFM, I don't know of a global DFM that does, a true global DFM that does blend balanced funds. In South Africa, I'm not too sure of different solutions. Our solutions, when we did bring them to South Africa, it was interesting. As Debra mentioned, there were a lot of people there, but it's, I don't recognize this manager, and we could say, but here's our research report on this manager, and it's Franklin Templeton, and here's Dodge and Cox, and so we've got all the data that backs it. But ultimately, what you want is a portfolio of conviction. You want portfolios that are going to deliver strong total returns to investors, and you don't want to overpay for that. And so if you can access that through a platform that's got the functionality such as yourselves, then that's a great solution.
Yeah, it's also actually interesting from a platform perspective. A trend we've seen actually in the local market is what you found is that actually when the kind of DFMs and model portfolios first came around, is that they actually, a lot of them used balance funds to create models, and I think the reason was because the advisors kind of fund universe was balance funds. So you kind of didn't want to have a huge CGT impact. So the DFMs kind of, used similar kind of what the advisor was doing. And then over time, that's changed to very much kind of your building block approach. Again, which has then obviously brought the costs down on your point. So it's actually interesting. It's actually, as you say, it's kind of, that was a more local phenomenon, but I think that's also that's shifted quite a bit to the more kind of the building block approach across most of the DFMs that we've seen.
Yeah, and Steve, sorry, just to add to that, it's everything is an evolution, and so when just the concept of a DFM, it's very hard if you're using balance funds to tell an advisor, and for an advisor to tell their clients, I'm just selling everything that you've owned that served you well over time, because trust me, that we're moving to a complete new strategy. So those relationships build over time, and they have relationships of trust as well. And you also need to build an investment track record. So from Morningstar's perspective in South Africa, we have a 5-year track record now, but it's very difficult in the beginning because people, whether they know the brand or not, for people to trust you, they have to trust something that is based on fact. So we can tell you we have a global track record, but that doesn't necessarily help South African investors. So these things do take time. And as I mentioned, even the evolution of platforms, just allowing that functionality, allowing that transparency and access to different managers. So there's no right or wrong. They evolve.
Yeah. So now last question come through. Vicky, what is your view on passives?
My view on passives. I'm going to answer this from a global perspective. I think passives are fantastic investment vehicles for two functions. One is, there are 3 reasons you really want to own passive. One is for diversification. So globally, you really do get that. You get indices of 2,000 shares, and so you get diversified exposure, which is not necessarily the case in South Africa. The second is cost. So our team in the US run a target risk, like a global portfolio built only using passives, and that portfolio is 8 basis points. So if you can build a portfolio for 8 basis points, that's very meaningful. For every basis point you save, that's an additional basis point of return for an end investor. And the third place passive plays a very important role is where an asset class, either you can't access an asset class, or the active management fees over time have proven not necessarily to be successful. Japan's a great example of this. If you look at passive investments in Japan versus active managers over time have really, really struggled to outperform the index. South Africa is actually quite a good example of that as well, and over the last few years in passive versus active. But passive plays a fantastic role in access to an asset class where it's also so cheap that you don't need to pay for active management because you're buying everything at depressed levels. So we do use passive. We use passive where it makes sense, and we use passive where it makes sense for those reasons.
Yeah, absolutely. So just another good question that's come through, which I quite like, is, so earlier you spoke about kind of global managers coming into SA in the early 2000s, and then disappearing, and now they're back. I mean, so what the one question I suppose is, what certainty do we have that the guys are going to stick around? Another two is that, what certainty do we have that you guys are going to stick around? You're a global business. Yes, you've been here for 11 years, but as the function you run has been here for 6 years. So what assurance can you give to the audience that you guys are going to stick around? Vicky, good.
Yeah, sorry, I know I'm doing all the last few talking, so I'll try and keep this this short. But Look, Morningstar is an incredibly principled business. So it's a business that genuinely has the end investor front and center of every decision that it makes. The foundation of the business include core principles of independence, transparency, and long-term investment thinking. And the reason I say that is because long-term investment thinking translates not only to portfolios you build, but businesses that you build. And I'm a runner, so I love this quote, but Joe Mansueto, who's the founder of our business and still the chair of our board, he once he used this quote. He said, "We want to win the marathon. We don't want to win the next mile. The short game, it's a hard game. We don't see many people building wealth on that dimension." And I think that can be applied to businesses as well. So I founded the SA business, the investment management business, and it's been an incredible journey because I've been given the space to build the right business for the long term. So what that means is, first and foremost, building a solid investment team and capability and operational capability to support that, to build a culture of investment focus, collaboration, and ensuring that the end investor is front and center of every decision we make. So part of that means working with what we term like-minded advisors. What's a like-minded advisor? Well, it's somebody who also has the end investor front and center of everything they do. And when you work with like-minded advisors and you work with the right partners, you can grow a sustainable business. And we've actually been able to do that. So as I mentioned, I've kind of had the space to build a business that's allowed us to grow organically and to grow well. And it makes it very easy and very rewarding. So it's not easy from an investment perspective, make no mistake. That's the tough part, but the business part is easy. So we'll, from a Morningstar perspective, they are committed to SA. They're committed to our clients. We're investing more in the country. So we are here to stay, Steve. With regards to the global managers, I mentioned that managers came and left, and those managers are actually not really here anymore. And I think the managers that have come in have actually learned from history. And so they have built distribution and presence in South Africa, and they also have brought good products. So even over these 2 decades, you've seen a much stronger shift to good investment product as opposed to just selling investment product. And if we look at those managers, I mean, to me, one of the biggest success stories in South Africa is Schroders. We've done a really good job in terms of building a good network, good distribution, boots on the ground. As I mentioned, Veritas, Dodge, and Cox. You've got a lot of these managers, and it's not like they've gathered huge assets in the beginning, but they've built that trust with advisors. And so I don't think, I think they're here to stay as well. I think the ones that were flash in the pan, they came 2 years later, they've left, but the rest are here for a while. It's
always interesting when guys actually, and I know some global guys kind of fly in and fly out, but Schroders is a good example. I mean, they got boots on the ground. I think, so which is always, when they got a real presence, I think makes a big difference. Just quickly on your team, Debra, I mean, you've recently joined, when I say recently, I mean, it's probably just under a year now that you joined Morningstar. I mean, and the team's grown. I mean, I know the team's grown quite a bit for the last little while. I mean, Debra, it's obviously a good move for you, and you're enjoying the culture and the change.
Steve, absolutely. It's actually just been 6 months now. It feels like 5 years.
A crazy 6 months.
Crazy 6 months, moving down to Cape Town, moving houses, moving companies, then going into lockdown. So it's been an incredible experience, and I am so proud to be part of Morningstar. It's an incredible team, not just on the local side, but on the global side. So I'm very, very happy. Yeah.
Good. Another question for you, Debra, is, so can you give us some examples of the asset management companies you like from a global perspective that you hold in your portfolio, or you don't even hold them, but they're on your watch list or your radar?
I think like is a strong word. Morningstar is very independent, so we're quite proud of the fact that we're quite independent. We're not married to any asset manager. We're not married to it's completely independent. So, and as I've mentioned earlier with model portfolios, just be aware that the underlyings can change, and we do warn clients in advance if we're going to make a change. And why does it change? It's because there's market movements, and because sometimes our asset allocation views change. So we do make changes in the portfolio. We don't fire managers just for poor performance, just a big disclaimer. We actually go through a very rigorous process when selecting managers. So currently, to give you an idea of some managers that we have exposure in our portfolio, it's the likes of a 91, the Global Franchise Fund and Notes Fund, very well known by South African investors. We've got a very nice exposure to that. Dodge & Cox is a little bit more of a value style manager. Incredible manager. I know they're deeply out of favor at the moment. They've really had a tough time, and I see Vicky smiling there. We've actually had a lot of conversations where clients are asking us, like, please, why are you still including Dodge & Cox? It's one of those phenomenal managers that's just top quartile across different market cycles. So they do have a bit of a value style. So the exposure at the moment is quite deeply out of favor, but we really like them. And it's quite interesting about them. No matter where in the world you access that fund, it costs you 63 basis points for an actively managed fund. It's actually incredible. So we really like the guys. The average tenor for some of the fund managers there is in excess of 20 years. I mean, that is absolutely incredible. On the emerging market side, we like the likes of a Fidelity. There's a Franklin that we also quite like. You've mentioned Schroders previously. Fantastic manager. We don't have Schroders exposure in our portfolios at the moment, but a phenomenal manager, very good Morningstar rating. So when it comes to areas of Japan, like Vicky has mentioned, we actually just go passive there because it actually doesn't make sense to invest in active managers. So we'll just go and buy a tracker. So there's loads of good managers. We actually cover the whole globe in terms of manager research. And then we go, when we formed our asset allocation view, we go and express this view with the managers that we've selected. I don't know, Vicky, if you want to add anything to that.
Vicky's hand did go up.
Yeah, I've got my hand. I was going to say the Schroders European Fund we're actually adding to the portfolio, so it's just been a function of getting it available on platforms, but that is coming in.
Okay, so there we go. So Edith and the team would be happy with that. Cool. Some more questions. So Debra, what are some of the characteristics one should be looking out for in a DFM?
I think there's actually lots. I think the one thing, so a lot of people, I think, get stuck on performance, and that is incredibly important. But performance needs to be the consequence of a good process, a process that you follow over time, consistently, and through different market cycles. So obviously the fees that you're paying, incredibly important. A lot of people look at DFMs and they say, but I have to pay now 20 basis points additional fee. How does it actually add value to my client? So, and we spoke about model portfolios earlier. It actually brings the cost down because these advisors can actually go or these DFMs can go and get access to specialist managers. So, and you have to look at total TIC, very important, not just the 20 basis points that you're going to pay for a DFM service. Then I think a couple of other things to look at how the DFM makes their money. Incredibly important. So Morningstar only earns one fee and one fee only on one level. So we only do well at the end of the day when our clients do well. So there's a big alignment there. We only earn 20 basis points on the money that's actually managed within the model. There's no additional layer of fees, and we're 100% transparent about that. So when you assess a DFM, make sure that you look at least a decent track record, the fees that you're paying, and then look at the additional value add that you're getting. So what else are you getting that you can't get elsewhere? I've mentioned Morningstar's got incredible tech available. So immediately when people sign up for us, that's not our Morningstar direct system, but we've got other systems that we run that advisors can do comparisons on. They can use it as a record of advice. They can access risk tolerance questionnaires. And then Morningstar's incredibly passionate about the behavioral side of investing. So we've got a team of dedicated behavioral specialists sitting in the US. We've flown them out before. We hold webinars with them. There's a huge amount of benefit for advisors to actually be roped into that. And then, of course, any of our talking points and thought leadership and additional commentaries and market information and market calls. So make sure that you know what you're getting yourself in for. So it's, yes, performance is important, but the process that allows performance to happen is even more important. Then, of course, the fees that you're paying. And then the third one is what's the additional value add. And I'm sure Vicky's got something to add to that as well.
The hand went up again. Yeah, go for it, Vicky.
One last comment to that. There's a distinct separation or divide in DFMs between independent and between what we term vertically integrated. So a lot of DFMs would have their own funds or their own platforms or their own mancos. So when Debra mentioned the different fees, I think that's just to kind of bring clarity to that. It's to know you can maybe have a lower DFM fee, but you're buying a DFM's funds in your own portfolio. So it's just to understand that. Not necessarily a good or a bad thing. It's just to understand the total flow of money.
I mean, I'm not sure you answered the question, the audience, but actually what might be worthwhile is I wrote an article a while ago on kind of the process one should follow when choosing a DFM. And again, I think, Debra and Vicky mentioned two very good points there. But again, from my side, I think it's very important that you understand the business and that it fits with your advisory firm is so important. And also then, and one thing is running the model portfolio and the actual solution, but all the other benefits and kind of services that the DFMs bring are also very, very valuable. So again, if one is looking for a DFM, I think it is worthwhile go onto the Innate website and as I said, the article is there. Have a look at it. I think it gives you a kind of nice framework of how to actually go and choose a DFM. Okay, cool. So just another question, sorry, for Vicky, is actually just on a CGT question. So can you discuss some of the tax benefits of model portfolios? Does it trigger CGT for clients when changes are made within the portfolios? So obviously some serious interest in kind of model portfolios and DFM services coming through from the questions.
I'm going to address that both at a global and at a local level. So yes, every time a transaction is made, if you disinvest from a fund, a CGT event is triggered for discretionary investments. From a global perspective, if you think of typically you've invested in 4 balanced funds, what happens is that CGT is going to be triggered on exit, unless it's in an endowment or a wrapper. But let's just assume there's a tax event and you just invested, it's straight discretionary investment. The fact that we build portfolios at a very granular level means that when we make changes, so whether we rebalance, you do get a tax event, but you can actually use your allowance. So those events are smaller. So we, for example, might trim down our US Treasury exposure or increase the Japan exposure. It's quite marginal. So you're very unlikely to see us disinvest entirety from one fund that would be 20% of the portfolio that would result in a huge capital gains impact. I can say so I've been doing this for the Morningstar for 6 years and prior to that for about 5 years. And I've never had a capital gains issue with regards to managing portfolios in a building block manner in the way we do on a global side. So there is a capital gains impact. It does use your allowance and it should hopefully be small. And we do always give warning if we're going to be making a change, and we allow advisors time to say, actually, I don't want to be part of that. And as Debra mentioned, you could actually just unwrap a client from a portfolio, so there's zero client impact if you did not want to continue to be part of the portfolio. So we try and build portfolios from a functionality perspective that it's seamless for investors to disinvest if they want to. There's no client impact. On the local side, for discretionary investors, yes, there is CGT every time you disinvest. again, using a building block methodology actually means that you can get to use your allowance. It is a use it or lose it. We're of the view that CGT is a wealth tax. It's very likely to increase over time. And so that making sure that you do actually use your annual allowance, and one of the benefit is good, and one of the benefits of model portfolio functionality is that every January we actually just realign the portfolios back to static weights. So we do sell, we do basically top up the things that have underperformed, sell the things that have done well, and make sure that that allowance is used.
Yeah, no, cool. I'm aware of time, so we've got 3.5 minutes left. Before I close, are there any kind of closing remarks from either of you? And then I'll close.
I think from my side, a closing remark would be one, and this, I know the topic was global, but Steve, your comment about DFMs, we would absolutely encourage anybody who wants to use a DFM to do as much homework and research as you need to, ask as many questions as you can. Unfortunately, there's no playbook. It's not like asset managers where there's one exact way in which to view a manager, and so everybody does something differently, but yet it's lumped together in one consistent sort of bucket, if I can call it that, and speak to your platforms and ask them the questions around who's good at trading, who's good at managing flows, who's good at fees, who run good portfolios, and then also know that you also want a solution that is good for your investors if you ever didn't want to work with a DFM. Like, it's nice to form a partnership, but how good is the exit? And then when it comes to global investing, which was just the theme of this this webinar, is to say, I think so much of the complexity has been removed, and as advisors, there's never been a better time to actually access great global managers at low prices, low fees, through platform functionality. Debra mentioned tech. Innate's been built around advisor needs and around tech. So there's just the landscape is so different, and it's exciting. I think it's a fantastic time to be investing offshore.
Yeah, there's a client need as well, which is very real. So Debra, I don't know if you're in closing remarks. There's one more question for you, which is, what is the process to invest with Morningstar? I suppose what's the best way to get hold of you two is maybe is maybe a better question. So I'm quite happy to answer on your behalf, because we did speak about it before in case it came up. Is it in the but
maybe before you go into that, so maybe I'll just mention that just in terms of process from our side, extremely seamless, extremely easy. There's a form that we'll send to you, and that's just really for our own compliance and for us to communicate with the platforms to open up access to you, because we're very selective in the way that we grow our business. We partner, and Vicky has mentioned this, we partner with like-minded advisors. So we would like to do a reverse due diligence on the guys that wants access to our portfolios. So after that, we'll open up the portfolios on the platform, and then just very, very important, there's an end investor consent form with the onboarding process, very easy. We'll explain all of this to you, but very important. So that form is just to say that the client gives us consent, because essentially the money is going to be managed on our Cat 2 license, if you think about that. Steve, I'll let you answer how they can get hold of us. But so extremely easy process, and of course access to all of our tech. All of that will be in the welcome email.
I was going to give everyone your telephone numbers. And this was going to be so if anyone does want to get hold of Vicky or Debra, is actually to two ways. One is, more than happy that you contact myself or your Innate BDM. We've got great relationships with Morningstar, and actually all the DFMs, as actually Vicky mentioned. So yeah, please feel free to get hold of us, and then we'll happily pass on the kind of the lead to Morningstar. Another avenue is always LinkedIn. So both Debra and Vicky very active on LinkedIn, so you can just send them a private message, and I'm sure they'll come back to you. But that's it. It's 10:30, so we've come to the end of our webinar. First off, just a really big thank you to Debra and Vicky. I really do appreciate your time and input, and I think it was a great conversation. So thank you very much.
Thank you, Steve.
Yeah.
Thanks.
And then just importantly, a CPD process reminder, as I have to. If you attended majority of the webinar, you will get your certificate in the mail email tomorrow. If you weren't able to, or if you watched with other people, so you aren't a unique kind of login, then you'll need to complete the assessment, which also will be emailed to you, and then you get your certificate. Thank you to everyone for joining, and we really do appreciate your time. I know it's very, very valuable, and there are a lot of these webinars out there at the moment. And otherwise, I think that's it from our side. Our next webinar in the Room series is actually with Fairtree, and that's happening I think the second last week of August. I forget the date offhand, but otherwise look out for all our different kind of value added webinars are coming up. Cool.
18th
Thanks
of
everyone.
August.
Thank you. There we go.
Okay.
Yeah.
Thank
Cool.
you to everyone.
Cool.
Thank you.
Thanks all. Shot.
Bye.
Cheers.
Bye.